Good evening, everybody. It is Wednesday, May the 20th, the Wednesday before Memorial Day weekend. Hope everybody has a wonderful Memorial Day weekend upcoming. But the holidays arrived a little bit early today because the market definitely gave us some good news. And let's take a look at the numbers. We had a 645 point up day on the Dow, 1.31% gain, closed just over 50,000 on the Dow. S&P gained 79 points, a gain of 1.08%. NASDAQ gained just shy of 400 points, or 1.55%. Russell 2000, big winner today, was up 2.56%. The volatility index in the fear gauge actually came down about 3%, sitting a little over 17 right now. Really nice bounce back day in the stock market, kind of across the board, and that was led by oil prices coming down. Let's just take a quick look. Oil, which had recently in the last couple of days gotten as high as $108 a barrel, is presently back under 100 at 98, down $5.80, and that's actually on top of that is an after hours move. So we've seen a big move in the price of oil. As a matter of fact, just to show you a 5-day chart on the price of oil. You can see how much it came down since earlier today. We were 103 and change. Nice big drop in the price of oil today. And again, not on any specific news related to the war, but I think continued optimism that this is going to get resolved relatively soon. I guess the market must know more than we're hearing in the news, because we're not hearing any specific solution yet, but maybe this is an anticipation of good news coming in the not too distant future. So oil prices coming down as sharply as they did not only helped the stock market here in the US, but if we look at Europe, Europe also had a really strong day today. The European stock 600 was up 1.46% for the day. Germany, the DAX in Germany was up 1.38. The FTSE in the UK up just under 1, and the CAC in France up 1.7. And as you would expect, if oil prices were coming down, that would take some of the pressure off of long-term interest rates and primarily the U.S. 10-year Treasury yield. And sure enough, if we look at the 10-year U.S. Treasury, down 8.5 basis points today at 458. Now, what I will point out is we did get, in this little run-up here in the last few days, we had already recently breached what the previous high had been on the 10-year yield, going back to April of last year when the 10-year got to, I think, 4.61. If we look at a 5-day chart on the 10-year here, you can see looks like it peaked at about 4.685 on Monday. Actually, that looks like early yesterday, 4.685. So we had run substantially higher on long-term interest rates as oil prices had been pushing higher, a lot of anxiety about inflation accelerating, and we're going to take a look at those numbers in a second. But this is a 5-year chart on 10-year Treasury yields. And this is really the most important yield as it pertains to the U.S. stock market, and I would say it's probably the most important yield in the world. And if we look at where interest rates are here, if we go back to 2025, early 2024, 4.61, it looks like. Here we got into January, 477. During the right prior to Liberation Day, where we postponed the tariff implementation by 90 days when President Trump announced that, we were hovering around 4.5. So the range we're in right now, this is kind of the high end of the range. As a matter of fact, if we shorten this up to a 1-year chart, you can see that in the past 12 months, where we hit earlier this week was actually the highest interest rates that we've seen on the 10-year Treasury. And that is a really important interest rate because that affects mortgage rates, that affects longer term commercial loans, it affects car loans, it affects a lot of things, and it also affects the multiples in the stock market. So the irony is, if we look at this chart, over the past year, and you look at this low point, February 27th, that was the day before the war began, the 10-year Treasury was at 3.94% was the low. So we've risen 64, 65 basis points, even with the sharp drawdown or pullback in interest rates that we saw today. Heading to those higher levels, that puts a lot of pressure on the bond market. To put it in context, a 65 basis point move on 10-year treasuries, if somebody owned $100,000 in 10-year US treasuries right before the war began, that $100,000 worth of treasuries is probably worth about $95,000 right now. It's probably that big of a move up in yields would cause that big of a discount or a reduction in the price of those bonds. So the average 10-year security, US treasuries, and then everything else prices off of that, you've got bond prices down by about 5% in the last, 2.5 months. And the stock market staying as strong as it has been in spite of those higher interest rates is definitely something that has been somewhat surprising. I would suggest very encouraging. Obviously looking at the glass half full on everything that's happening geopolitically, but what I would say is we are at pretty critical junctures for the market in general. Something has to give in one way or another. And what I would suggest is either you need oil prices and interest rates and inflation to come down, which would then help support current stock prices and potentially even higher stock prices, or you are likely at some point, if interest rates were to stay in this range and push higher yet, same thing with oil and inflation, at some point that probably breaks prices within the stock market. And so today we kind of had everything going in our favor. In interest rates came down, that helps bond prices. Oil prices came down, that helps everybody except oil companies, but it helps sure the rest of the broader market. And then you had, with oil and interest rates coming down, that obviously elevated stocks really globally, and that's really a encouraging thing to see, that the market just kind of has continually gone back to that thesis, even though we haven't seen the actual resolution of the conflict yet. But I would say if the market is a predictor of what is coming, is predicting very good things. So pretty exciting on that front. Looks like SpaceX getting ready to go public. That's going to be very interesting. Will be probably the first $1 trillion plus valuation in an IPO in history. So again, more assets likely coming into the stock market as a result of that IPO. When I look at other areas of note today, we did see a little bit of a rebound in precious metals. We saw the dollar index, actually the dollar declined slightly today, so basically the DXY, which is the US dollar index. On a day like today where interest rates were coming down, oil prices coming down, likely that the dollar would have been down, and sure enough, the dollar index down about 20 basis points. So you're seeing the responses in all the asset classes that you would expect to see on a day like today. When I look at forecasts for the overall economy, the Atlanta Federal Reserve GDP Now forecast, this was updated last 6 days ago, and it was still projecting a 4% GDP growth for the U.S. economy in the second quarter. That's pretty darn robust and pretty strong, especially when you consider the tax on the economy that higher oil prices have on consumers. More money going into the gas tank, less money to be spent on other things. But the overall economy still seems to be holding up pretty well, and clearly the market is certainly another indicator that it believes that the economy is holding up pretty well. Inflation is clearly getting pushed by higher oil prices, though. When we look at the inflation nowcast from the Cleveland Fed, the projection for the month of May, headline, 0.46% for overall inflation. If you extrapolated that, if you round that to 0.5, multiply that by 12, that's 6% annualized inflation. That's probably about where things are at the moment. But we know that that really accelerated quickly in the last 2.5 months since the war began. And I think the hope and the expectation is that if you get a resolution to that war, that oil prices will rapidly head back to where they were pre-war and maybe even lower. And then this inflationary pressure that has been building and has caused a lot of consternation for consumers, I would suggest not a lot of consternation in the stock market. That first month of the war, we had a little bit of a pullback, but over the last 7-8 weeks or so, it's been pretty, mostly trending rapidly to the upside. So a lot of anticipation of good things coming geopolitically, and then also a behavior that would be indicative of an economy that looks like it could weather this volatility and higher oil prices that it's currently dealing with. The reason why interest rates are so critical, and one of the reasons why President Trump has been advocating for lower rates, and I think all presidents want rates to be lower if possible, but I think even more critical in this period that we're in right now is just the amount of debt that we are servicing as a country at the moment. When we look at the U.S. debt clock, we've got the total national debt right now over 39.25 trillion, borrowing still, even though the budget deficit is coming down, but still not quickly enough to where we still are borrowing a lot of money every single month, which just adds to that budget deficit. And then all of that leads to the interest that we have to pay on the debt. So if you think about it, total federal spending is $7.127 trillion. That's the projection on federal spending right now. But of that, over $1 trillion is the interest on the debt net, meaning this isn't just the interest, the total interest, because they're not even in that total that is over $1 trillion. They're not taking into account the money that the Fed printed out of thin air, the treasuries that they hold, that they collect the interest on, but then they remit that interest back to the federal government. So meaning that interest isn't being counted. Part of that, all of that money printing is some of the inflation that we're still dealing with. But what I would point out is, if you think about it, if $7 trillion is the total federal spending and over $1 trillion is the net interest that we owe on the debt, 1 out of every $7 that we're spending, over 14% of total federal spending, is interest on the debt. And if interest rates were to go higher and stay higher for longer, as older bonds mature, many of which were issued at lower interest rates, because we know that coming out of the financial crisis in 07, 08, 09, that from 08, when Lehman failed, up until really, let's say 2022, most of that time interest rates were 0 or close to 0. So a lot of that debt was issued, especially the longer duration debt, was issued at relatively low interest rates. And not only do we have new debt that we have to pay interest on, but if the rates on the old debt as that matures and then has to be refinanced at current rates, which have been going higher as of late, all of that accelerates the interest service on the debt. And so when I say, the one thing that we have been, focused on as far as potential challenges for the market, the bond market and servicing of debt for the country is probably, I would suggest, short of is probably the biggest economic risk that we face as a country. And so it makes it even more imperative that we get a resolution to the war, energy prices down, inflation pressures down, that would enable interest rates to come down, that would then lower debt service on all of that debt that we have. And I would say today, getting a nice reduction in the 10-year Treasury yield kind of took a little pressure off the market, and you can see the market just lifted like crazy as soon as it saw some of that pressure on long-term interest rates come down, and that allowed for the market to respond in a positive way. But when you think about interest, I've used this analogy for the last few years, that when you think about the debt that we've accumulated as a country, just to go back in our time machine, we didn't always have this level of debt. If we go back to 2000 as an example, we only had 5.7 trillion in total debt 26 years ago. So in the first 200, we're celebrating our 250th year anniversary this year, and in the first 224 years, we borrowed a total of $5.7 trillion, okay? If you fast forward to 2008, right prior to the financial crisis, we were up to about 10 trillion. So we nearly doubled the amount of debt in the next 8 years. So we went from 5 trillion and change to 10 trillion from 2000 to 2008. But then when we had the financial crisis, the government stepped up spending, the government stepped up borrowing to try to fill the gap for all of the problems that the banking system had and the housing market had. And if we look at the next, fast forward to 2020, to the beginning of the pandemic, we had gone from 10 trillion to 26 trillion. So the debt increased by over 16 trillion from 2008 to 2020. But then from 2020 to 2026, in just 6 years, we've gone from 26 all the way now to where we sit today at over $39 trillion. So the debt is an issue. And the debt, servicing that debt, if you think about it, from 2008 all the way to 2022, when the Fed had short-term interest rates at close to zero, and the 10-year Treasury was somewhere between 1.5% and 3%, it's kind of like running up the credit card, but the credit card company saying, yeah, you only have to pay, let's say, 1% interest. Well, you can swipe the credit card a ton, and it really doesn't feel too bad when rates are that low. But what we've had happen in the last few years, and now as this amount of debt has continued to build, we now have a situation where you've accumulated all this debt, and now what's happening with interest rates is, especially now that there's more inflation concerns, you've got bondholders demanding more interest to account for loaning that money out over a period of time, and then recognizing that if inflation is a problem, and let's say, think about this, if inflation is running right now, we've been well over, let's say 2.5% on the low end, and now at the moment we're probably running closer to 6%. How much interest do you need to get paid over 10 years if you buy a $100,000 note from the US government, and 10 years later they're going to give you back your $100,000 and then pay you a fixed flat rate of interest over that 10-year period? Right now, today, what they're paying is 4.56%, okay? Taxable. So you don't even get to keep all of that. So if you've got to pay taxes on that 4.56%, and let's assume 20% for taxes, that's about 90 basis points. That brings you down to 3.66% net after tax. And if inflation is running at higher than 3.6, you're actually losing money over 10 years on a government bond. And so this is the reason why getting inflation back under control is so critical. And that's clearly the role of the Federal Reserve. But the U.S. government and how much money they spend, how much money they borrow, how much they need to finance, all of that factors into this as well. And so when we've seen long-term interest rates go from 3.95 all the way up to 4.56 just in the last 2.5 months, the concern is that if it gets much higher than that, that all of a sudden there may be a loss in faith in the bond market, that all of a sudden bond investors start feeling like inflation is getting back out of control, that they need more and more yield to justify buying those bonds. And then that higher interest rate means we have to borrow even more money because we have so much money that we've already borrowed already that you've got to continue to service. It becomes what they call a debt spiral. And that has not happened yet, but I think that the market, you're starting to see some articles written about how critical it is that we get through this period as quickly as possible to start bringing some of those pressures down. And today was a day where, at least for today, oil prices came down, bond yields came down, stock market went up, really good outcome. Clearly, it's a ongoing bet that this whole problem with Iran is going to get resolved relatively soon, and that these pressures that we're dealing with right now are somewhat temporary and ultimately will get resolved in a favorable way that allows the economy to continue to stay strong. Time will tell if that's the case. I can tell you from our perspective, what we have done within our models is we have shortened the duration of the bond portfolios across the models. We've added a little bit of additional gold exposure in the models because gold has pulled back to a level that we think is attractive again, and we like having some of that in the portfolio as a diversifier and as a hedge. And clearly, we like especially higher yielding, higher quality equities. But this rally, it was nice to see this rally was a broad-based rally today, but up until the last probably few days, most of this rally has been concentrated in the arena of the big tech companies, and the biggest of them all, NVIDIA, reported earnings tonight after the bell. And let's just take a quick look and see what the news is here. It says NVIDIA beats on revenue and guidance, adds $80 billion in buyback adds $80 billion to buyback plan. So clearly headlines, that looks very positive. If we look at the stock itself, how has it actually responded after hours to that news? So far, actually slightly negative. So as of 5:03, a little bit of a pullback. Now, why would that be the case? Why would NVIDIA stock, at least for the moment, not yet be responding to what appears to be on the headlines very good news? What I would suggest is, if a lot of that good news was already priced into the stock prior to the earnings coming out, then you might not see the kind of reaction to that news that one might hope for when you get that good news if it's already priced in. So if we look at the last 3 months on NVIDIA, there's a lot of good news priced in, right? If we go back to late March, 167, NVIDIA has gone from 167 to 223, right now 222 in after hours. So a lot of good news was priced into this quarter's numbers. So not necessarily a shock to see a little bit of a pause or a breather on the excitement in NVIDIA, but who knows? Jensen Huang could come out and in his post-earnings Q&A session on the conference call, it might say something that causes the stock to jump nicely or move the other direction. Looks like the news has been pretty good for NVIDIA and continue to be good. Obviously, that's good for broader U.S. indices because this is clearly just an enormous stock. We're talking 5.41 trillion in market cap, so almost 5.5 trillion in value. That accounts for, I want to say, almost 9% of the S&P 500. So clearly, NVIDIA continuing to hold its value is important to the broader indices being able to make progress moving forward, and it's certainly contributed majorly to the run-up that we've seen in the last few months. So in closing, I just want to say, great day in the market today. The market stayed very resilient. We at least saw a temporary reprieve in bond yields coming down, a little reprieve in oil prices. All of that is certainly welcome news, and hopefully we'll continue to see that, and hopefully we actually get the news that the market is really on pins and needles about, which is getting this conflict in Iran resolved and getting the Strait of Hormuz reopened so that we can get the free flow of oil moving again. But hasn't happened yet. But the market is certainly behaving as though it's almost a foregone conclusion that it's going to. Let's hope that the market's right, and also let's hope that that happens very, very soon. In the meantime, have a wonderful Memorial Day weekend. Thank you for taking the time to tune in. Thank you for your continued faith and confidence in our team. And until I see you next week, stay safe.